Howdy, y'all. It's Austin at Homeowners Financial, and this is, of course, the ABs of C's of Lending Part 2. We got 3 different parts, and the whole goal of this is so that you know exactly how things move really in mortgages, right? How is it going on? Who's on first? So let's just talk about this in general. This is your life. This is your options. These are your success. Last time we covered loan types, program types, and transaction types. Today we're in Part 2, the 4 quadrants of qualification. Every single loan has these 4 boxes. It's the income, it's the assets, it's the credit, it's the property. Each one can relate differently. And different loan programs are really going to qualify differently, but they all have income guidelines, they all have asset guidelines, they all have credit, and they have quality property. Now, when you apply for a mortgage and we're doing your pre-approval, the only thing we don't know is the property. Right? We should know about the income. We should run the credit. We should do the assets. We should have all these pinned down so you can find the property and focus on that once you're in escrow. So let's just start with income. It's not about how much you make, but how you make it, right? So your base pay is really what you're guaranteed to make. This is your salary. Like, I will work X amount of hours, and if I don't work X amount of hours, it doesn't matter because I'm still getting my salary. I'm getting my base pay. Now, variable pay is when or is changed based on how much you work, right? So think of hourly, like how many hours a week do you work? Are you working overtime, right? Are you earning commission because you're selling things? Are you getting bonuses? And then you're self-employed when you work for yourself. And some clients are like, oh no, I work for my corporation. Like, no, it is your corporation. You work for yourself. You are self-employed, okay? It could be a partnership. It could be a corporation. It could be just your general, just individual sole proprietor work as well. It could be through a lot of different vehicles, but it means that you're working for yourself or that you own 25% or more of a business. And then passive income, these are things where you're not necessarily touching it every day. So these are rental properties, right? They pay rent once a month. It goes from there. These are investments, stocks, bonds, dividends, interest, things like that. This is retirement, right? Maybe it's a pension, maybe it's Social Security. Different assistance, could be disability assistance, right? And could be child support, things of that nature. And gifts do not equal income. Some people are like, oh, well, my mom just sends X amount a month for me to live on. I'm like, that's great. That's called a gift. That is not income. You're not earning, you're not working, you're not generating that pay. That's somebody just giving it to you. Now, most income should have been earned and reviewed over a 2-year history, right? So you should be having it, it's consistent. There are different things that can change with that, right? Maybe you just graduated college, you're starting a new job, but income should be expected to continue for at least 3 years at the current level, right? So if you say, hey, I'm retiring in a month, let's just use my current pay, that's not a thing because you're retiring in a month. All right, so let's talk about assets. This is, again, not how much you have, but how can you access it? We do a lot of loans for folks in the entertainment industry, and there's certain vehicles that they set up where you cannot actually access the funds. If you are a firefighter, right, and you work for CAL FIRE, if you're in the public teaching administration, my husband used to work for Fish and Game, right? That's Cal PERS, right? You cannot access that until you separate from the actual company, or I should say the institution for which you're working, right? And funds are verified for the down payment, which is the percentages again, right? The closing costs, right? Title and escrow fees, loan fees, interest, taxes, all these things that you show up at closing. And then reserves, how much money do you need on hand at closing? And again, different programs have different qualifications where each of these can come from. So what's considered a direct account are things that are in your name. Your banking account, your checking account, your CDs, your savings, right? Your investment accounts, money market, right? Your stocks and bonds, right? I bought some Apple. I shouldn't really say Bitcoin, that's a totally different thing. But anyway, and then of course your retirement accounts, and I touched on if it's the public sector and the private sector and how you access it. But then there's indirect accounts, and these are things that you can't directly access, right? Gift money, right? We're getting that from a relative, like to show that the donor can give it and their relationship to you, right? I'm related to the seller, they're giving me money. Well, that's not actually, that's called a gift of equity. That's not necessarily a true cash gift, right? Proceeds of sale, are you selling something, right? Are you selling, we literally had somebody that sold gold doubloons, pirate treasure. That's a thing, we can document it and you could use that. Are you selling the car? You really don't want to be selling like lawn furniture and things like that, but tangible assets that are real. Loan proceeds, right? Are you borrowing against your 401k? right? Did you borrow against your stock account, right? Now, unsecured debt is not allowed. So if you're like, oh, I took money from my credit card, I'm like, yeah, that's great, but you're gonna have to pay that back. I cannot use that money. You cannot use unsecured debt. It has to be secured on that margin loan, secured on that 401k, secured on another property, right? And then there's random miscellaneous things like inheritance or business funds, and I lent somebody money, they gave it back to me. Now, these things have a lot of extra strings attached. So ideally, we don't make sure that the money is in directly for your access. And if it's indirect, just expect a little bit more paper trail. Now, when we talk about gift funds as well, most of the time you can get them, but there are caveats around that. And your reserves always have to be your own money. So even if you're getting a gift for, say, the down payment for the closing costs, the reserves typically always have to be your own money if they're needed. So let's pivot to credit. Oh man, I talked to a client today. I was like, hey, you're an escrow. That's so cool, except that you closed all of your credit cards and now you have no credit score. Why did you do that? He's like, oh, I thought I was improving things. I'm like, did you read the thing we told you that says do not touch your credit? He's like, yeah, but I thought there was improving. But think of credit like high school, right? Why did his credit go to zero, right? You want a lot of people saying good things about you. You want to be that popular kid of like, they pay me on time. They've paid me for 10 years. Oh my God, it's great. I get the payments every single month, right? You don't want to be that creeper that nobody hears from, like this poor client that's like he cut everything off. Like there is no doubt on him. They're like, we don't know that guy. I ain't got nothing on him, right? And you also don't want to like have a lot of haters, right? Like, oh, they always pay late. Those things are maxed out, right? So when we talk about credit, I want you to keep in mind there's 3 bureaus. And there's 8 algorithms per bureau, right? So there's 8 different models per bureau. So now we have 21 scores. And not every creditor reports to each bureau, right? Some might report to Experian, someone to Equifax, some to TransUnion, and it's really all about data. So when people come to me like, I ran my credit score on Credit Karma, it's X, why is yours Y? And I'm like, again, 3 bureaus, 8 algorithms. I don't know, man. Maybe that correlates not reporting online where it's reporting here. What we run for mortgages are so deep because it's so regulated. Expect to see some variance between what you're pulling on Credit Karma. And again, it's all about data. So let's talk about that data. What makes up that score? Well, the main thing is payment history. 35% is payment history. Do you pay on time? The next one is capacity. Now, think of this as your balance to limit. Now, ideally, we keep about 50% or less balance to limit ratio. So if you have a $1,000 credit card limit, trying to never spend more than 500. Oh, but Austin, I pay my card down to 0 8 months. I don't care. Well, it's not that I don't care. The bureaus don't care, right? You went over that mark, boop, you're going to have a different credit score. So that's capacity. Now, if you're like, Austin, I have $1,000 on my credit card, and I don't have the money to pay it off. Another trick you could do is call in and ask for a higher credit limit. You owe 1,000, ask for 2,000. Just don't spend over that 1,000, right? Because the idea was to get that 50% threshold. The other thing is link the credit. I am 41 years old. I have had credit longer than my teammates that are 23 years old. It's a thing. I'm older. It's just going to happen, right? So when you're cutting up those credit cards, you're saying, oh, I've had this for 10 years. I never use it. Well, you should use it, right? They've known you for 10 years, right? Your friends that you've known for a decade know a lot more about you than those that you just met 5 minutes ago. The next one, 10% of this is mix of credit in the past 12 months. That is a very, very sneaky way of saying inquiries. So when you say I don't want to run my credit because I don't want an inquiry, if you're paying things on time, you're not overcharging your accounts, and you've had credit for more than 4 years and you have an inquiry, dude, you should be fine. If not, we have other problems, okay? So an inquiry is really only 10%. And then the last one is mix of credit. This one used to be weighted higher, but as people realize, like, well, not everybody has a mortgage. You're going to give people extra credit for having a mortgage when they don't have it, they have work. So mix of credit, right? Installment accounts, cars, pianos, student loans, right? Mortgages, revolving accounts, credit cards. Your score is then weighted over time. 1 year, 2 year, 3 years, and then 3 years and above. So let's talk again about payment history. So if you have a late payment, 35% of that score, but it's 3 years ago, it's going to be weighted less than if it was more recent. Okay, so that's credit. That's credit in a nutshell. So let's talk really about property. So property, these terms and your options are going to change according to the occupancy and the type of property. The occupancy is who's going to live there, primary owner. It doesn't just mean it's the only house you own, it's who's actually going to live there, right? Your second home, do you use this part-time? does not mean that you have rental income. That's an investment property. Those are investments where you have rental income. Now, technically on the IRS tax code, you could have a second home and rent it up to 2 weeks a year. Usually you can work with that from a lending standpoint. But on the flip side, let's talk about the types of property. Single family, this is a house. Planned unit development, this is a PUD, right? You may or may not have attaching walls. Hope Ranch here in Santa Barbara is a PUD. People don't think of it that way, but it is. It's a planned development, right? Condominiums, otherwise known as condos. And then there's units. Duplex is two units. A triplex is three units, and a fourplex is 4 units, right? So your best terms are for a primary single family residence, okay? The most restrictive are for a fourplex investment property, so they kind of go around that side. That's a lot of information. I'm trying to break this down and make it as adjustable as possible for you. So if you have questions, please let me know. My name is Austin Lamson. I'm here at Homeowners Financial. I'm very grateful for the opportunity to help, and I hope you make it a great, great day. Cheers.